Started here. All right. Here's the socials. Let's get started. Hello, Smart Money Street podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. Another great Friday with you.
Yeah. Great to have you in the show. It's Friday, and I'm back to having house issues again. Thankful to be a homeowner.
Well, I was going to ask you. I was going to start by asking if you got snow because they got dumped on in Vermont. I didn't know if any of that reached out to you.
We did not get snow. We got a little frost this morning, but yeah, the evenings have been definitely in the low 30s, but during the day it's warmer. So yeah, we haven't gotten any snow yet, but I do expect some soon, and I got to put my backyard hockey rink up soon, so that'll be fun too.
That'll be awesome. So what's going on with the house this time?
Yeah, so last week we had a piece of the equipment in the heating the hot. I don't even know what you call half this stuff, but it heats the hot water for the showers. I think it was called a circulator, and it broke.
Do you have an instant hot water heater? Is that why?
No, we have a tank. We don't have a tank.
Oh, you have a tank.
Okay. But yeah, so anyway, so there's a circulator that I don't know. It helps, but so it was making a loud sound. It was a very scary sound. So got somebody out here and they decided to replace it. It was within warranty, so they should have done it for free, but I couldn't figure out who installed it before the house was sold. So I had to pay somebody where I probably could have gotten the warranty from the other plumber who, it broke. Anyway, so I had to do that. And then a week later, I had to have him out again because it was making the sound. I'm like, what the hell's going on? And so the guy came out. He's apologetic. Anyway, the next night it sounded again. I'm like, what the hell's going on? So this other guy comes out. He's like, oh, well, he was nice, but he didn't, he didn't fix it. X, Y, Z's happening. He gave me this laundry list of things that I was like, okay, I'm going to shop this around. Like this is a very expensive quote for like, you want a whole new system and all new pipes. I'm like, no, we're not doing that. Let me go find my friendly neighborhood plumber. I have a
Didn't you know it's $1,000 for every project these days minimum? That's just what they do. They just throw out the $1,000 minimum out there, Kirk.
Well, here's the funny thing. So, when in my other house I was renting, I knew the equipment. Like it's not my equipment, but I understood it because, stuff happens and you figure it out. I don't know this equipment yet, so I'm still new. And so, I'm always afraid of getting taken advantage of because I'm not a plumber, right? I don't know. I have an electrician. I have a guy, I have my guy who I trust and he takes care of me. I had him do a bunch of stuff. He was good, took care of him. We're all good. Plumber, I don't have a plumber yet. And there's no such thing as a non-emergency plumbing incident. They're always an emergency.
Only in construction. That's it.
Yeah. So, I was like, well, I need somebody. So now I need to find somebody that I can just call them like, here's what's going on. Can you help me? And so we're going through that now, and it's painful. Because I called one company and they're like, all right, well, it's going to cost $300 for us to come out there and assess the problem. Really? And they're like, we can't come out here for another like 48 hours at least. And I was like, well, what about today? They're like, well, it's an extra 200. I was like, so you want to charge me $500 to assess the problem? And that's and so my my baked in cost already is $500, and then you're going to give me a quote, which I'm sure is not going to be cheap. So because I've already paid 500, you're going to overquote me. Like, no, I'm good with that. So I just hung up and called somebody else. I don't understand what kind of business model that is.
You're not billing right in financial services, Kirk.
Seriously, I should just be like, you should pay me $1,000 just to get me
$1,000 just to find out if I think you're a financial dolt.
Yeah, I mean, but then I called another guy and they're like, oh yeah, it's free. We'll come out and look at it. I'm like, okay, that's a good business model. Yep. And of course they get here and of course they're going to have to use them because my thing is screaming and it's grinding and I'm afraid it's going to explode. I know it's not, but it makes you feel that way. Anyway, so it's just, to me, it was just a funny walk down the road of how businesses operate. I don't know how this other business does it. Maybe people are desperate. Maybe you can't find plumbers, but I don't know. I've been able to find a few cents and it's fine. So I guess we'll see what happens. So that's been my week. It's been a whole lot of fun dealing with that. Fun in air quotes, but yeah. So,
Well, they'll probably sell it to you, Kirk, and say the reason we charge you is so that we're going to be the fiduciary that's going to let you know if there's really a problem or not. And because we've already been paid to come out there, if there's no problem, we're going to tell you. Where that person that says that they're going to come out for free is going to make sure they sell you something on the back end.
but there's the sunk cost. So I'm gonna tie this into finance for all
Here
of
we
us who
go.
are thinking about tuning out. That's what we call a sunk cost bias, right? Well, I've already paid 500. I might as well just pay the rest. And the cost should be $1,000, but instead they're going to charge me 3. Well, I've already paid 5. I might as well just go with the quote that they're giving me, even though it's probably a little expensive, right? That's sunk cost, and it applies for markets as well, right? So if I put in, let's say I buy, I don't know, let's say I buy the Qs. Let's say I buy the QQQ, the NASDAQ, and I buy it and my stop loss is like 5%. Okay, well, it's down 5%. Well, it looks like it's going to turn around, and like, well, I've already put this money in. I don't want to lose it now. I've already lost 5%. I don't want to lose 5%. So I might as well just stick it out. Well, now it's down 10%. Well, I definitely can't leave because that's 10%. I don't want to sell because that's money that I've quote unquote lost. And so you keep going and going until it's down like 20%. And you're like, oh shit, I definitely can't sell now. Well, the problem is you have this kind of lost money. And this is not a perfect example of sunk cost, but you have this money that you've quote unquote lost, and you don't want to sell and lock in the loss because that would be hard to take. Even if you decided to put that in the S&P 500 and it bounces back up, it doesn't matter. Like, that's not how people think. So sunk cost comes into effect in a lot of places. And the plumbing example is actually a great one because a lot of us do this in our daily lives. And business owners are the same. You're in a business, you run a business, you do a marketing campaign. And let's say here's a perfect example. You run a business and you hire a marketer, and you hire them, they start doing work, and immediately, you pay them like, let's say $2,000 just to start, setup costs or whatever it is. And now you got to start paying monthly for other stuff. Okay. But you paid them $2,000. So you immediately recognize this person's not a good fit. So what's the best strategy? Well, most people would say, well, let's just give them a chance. 6 months later, you've spent like 30 grand that hasn't worked because the guy was a nitwit. As opposed to realizing your problem right away, cutting your loss at 2 grand and going to find somebody else and making a decision. So the problem with human beings is sunk cost is something we don't like to give up on, when rationally it's a good idea to just cut your losses and say, I made a mistake, and move on. But we don't like to admit our failures. We don't like to admit that we made mistakes. So instead, we make bigger and bigger mistakes by not cutting it off when we should. And this is a really important cognitive bias. We all have it. It applies in life in many, many ways. I'll give you another example. And I hate to do this because some people are going to get mad, but I'm going to say it. If you're dating, and you're dating somebody, and you don't really love them, you're just like, you're with them, and you're like, well, we've been together forever. I don't want to leave because it's going to be hard. I'm going to have to meet other people. So you just stick it out, but you're not really happy. And it's not terrible. Like, they're not beating you, but like, you're definitely not happy. You'd perfectly be happy to shack up with somebody for the weekend if you could, because whatever, but you don't want to disrupt the relationship. One of those kind of things. Like, you're definitely not going on to the next level, but you don't really want to go back to square one. So you just kind of stick it out for years, and you just burn years of your life unhappy with this person when you could have been out there finding somebody new and finding your perfect person. So this applies in many parts in life, and we do this all the time. And I see this with people in all aspects of life. It's just important to understand it, right? And it doesn't mean that I'm not telling you to ditch your zero and go with the hero, but just think about the implications of you're not making a decision. Because no matter what decision you make, it's a decision. A non-decision is still a decision, right? Should I stay or should I go? Well, let me just think about it. Well, just quote unquote thinking about it is a decision. Your decision is to do nothing. And that's okay. if you mean to do that. But don't just do it because you're lazy. Make a decision cognitively and say, this is the best path for me. Now, it might be hard, but at least you understand you've made that decision. And once you make the decision, then you can take the next steps. But if you keep pushing it off, then it becomes a default decision just because you don't want to choose one way or the other. So I think it's just a really important thing that comes into play in the markets all the time. All right. So let's dive into a handful of areas. I'm seeing a lot of news in air quotes that is concerning. Before I do that, I wanted to mention one thing, and Doug's going to love this. I saw news this past week that Bill Gates is declaring global warming as a non-issue. It's no longer an issue. It's cleared up. Everyone go back to your business. So
as Florida's getting, Georgia's getting 20 degrees this week, and Florida is getting frostbitten.
Yeah. I mean, I have to ask, and the same thing happened for COVID, right? People were like, oh, you're being a COVID denier and you're a bad person. You're an anti-vaxxer and blah, 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 if you didn't agree with the propaganda. Now Bill Gates is saying global warming is not an issue anymore. It's not an existential crisis. Well, I didn't hear why. Why is it no longer a crisis? What happened? Was climate change no longer an issue? Is the climate no longer changing? What's going on? Are the sea levels not going to rise anymore? I'm scared. What should I do, Bill? I'm sorry. I have to point this out because I think I'm not saying that we do or don't have climate change. I'm saying I can't tell, and nor can anybody else. And it's all propaganda campaign to scare the shit out of people. That's really what it was. And it's not an anti-global warming thing that I'm saying. I want to be clear. And this is where people have to discern one from the other. You can say one thing and not also mean the other, right? These are exclusive things. What I'm saying is the whole thing was a propaganda campaign. What I'm not saying is that it's not true. I don't know if it's true. I'm not smart enough to know if it's true. And half the people talking about it are not smart enough to know it's true. My understanding of the whole issue is we cannot determine whether it's true or not. And you might say, well, scientists are saying this. Yeah, but that's not how science works. If you have 100 scientists on one side and one on the other, and the one disproves the 100, then it's not true. That's how science works. It's not a consensus. This isn't a popularity contest. That's not how science works. So I don't know what's true. I'm not a scientist. I'm not an expert in these areas. I identify propaganda. We see it a lot. And we mentioned this about a year ago, and we mentioned on the show that I thought it was very interesting that all of the global warming talk disappeared. Not a peep in the news. It shut off. It was like a light switch went off. It was about a year ago. And the conversation stopped. And then what happened about a month later was Biden came out and said, we are supporting nuclear. Now, if that's not a tell that it's propaganda, what is? If everyone has the same talking points and all of a sudden they all stop and then they start talking about nuclear, is it no longer important? So my thesis has always been it's a propaganda engine. And once again, not saying it's not true. I don't know. But what I do know is what propaganda is like. I can identify that pretty clearly. So when he walks back global warming as being an existential crisis, it just tells me it's bullshit. Like, because if it's really an existential crisis, that doesn't go away and it doesn't get swept under the rug. So anyway, I just wanted to point that out because Doug and I laughed about this when it came out. It's just like, I mean, it's like a side note. It's like a footnote and something else. They shove it under the rug while they're doing the shutdown. But anyway, I just wanted to point that out.
Follow the money, right? If
Yes.
someone stands to get rich off of an agenda, then you probably have to look at it as a suspect. And there's been a lot of millionaires made pushing the climate change agenda. And by the way, this is always a fun one to go by. It's hard to listen to the people that tell you to change your life when they will jump on their private Gulfstream to fly to Paris for a piece of cheesecake. For
Yep.
those of you that know what I'm talking about, I won't name names, but this is a real, and I'm sure there's a few people in Massachusetts there behind the, you know, where you're at, Kirk, who would jump on the plane for a to go visit a place for a one-stop shop.
Quite a few, actually.
Yep.
Yeah. I mean, so I think, and to be fair, I mean, Bill Gates is one of the investors in TerraPower, which is nuclear. So we've been saying this in the show forever. If you believe in climate change, if you believe that the world's going to die because we have too much carbon in the atmosphere, nuclear is the only option we have. It is the only option we have without bringing ourselves back to the Stone Age. And like I said, I'm not making a distinction of whether climate change is real. I don't know. I know that it's all determined based on models. Well, models isn't truth, right? Models have errors. They all do. So I don't know. I don't know what the truth is. But I do know that if this is important, then you should look at the facts. And the facts are nuclear is the direction. But all the tech bros have decided, hey, this is important because we can't run our AI. We need to get nuclear. So all of a sudden, nuclear is a thing now. And I think that's the reality of what happened. So if you look back in the last year when we talked about this, they decided, oh crap, AI is going to eat our lunch. We need to do something about this. Let's stop the climate change BS and let's focus on nuclear. And all of a sudden, everyone got in line. They start talking nuclear, and climate change is a non-issue. And I think even Greta Thunberg decided there's some other issue that's more important than climate change now. It's like a circus.
For her, it's boating.
Yeah, it's a circus. So anyway, my point is not to get down this road, but just to point out how the after 15 minutes later, just to point out that this applies to markets, and this kind of segues into some of the things I want to talk about today. This applies to markets too. There is a line of bobblehead people on the news that are constantly saying the same thing. We see it in politics. Trump calls it fake news, but you see it in politics all the time. Everyone's got the same talking points, the same wording. It's like they all have a script and they all read off it, right? You see these montages on social media all the time. So it's definitely a real thing. I've seen it. It's funny. But it's not just in politics. It also happens in financial markets. Some of it is contrived and some of it is completely accidental. Okay. The contrived stuff is usually delivered by like the Fed and the people that want you to think a certain way. Everything's fine. Nothing to see here. You know, remember the Naked Gun scene where there's the fireworks factory, everybody's dying and on fire. He's like, nothing to see here. Go home. You know, sometimes it's like that. So when the Fed comes out and says, the currency is perfectly fine, you should probably get out of the currency. Just to be clear, like if they ever say everything's going to be fine with X and the Fed says that, do the opposite, because that's usually the first sign that things are going bad. But my point is that when you're understanding markets, sometimes these things are done deliberately, like that as an example. We've seen it in the past. Just like with, who is it, Paulson and Bernanke, who came out and said, there's no problem with mortgages. They're perfectly fine. We're not seeing any indications of this. And then, of course, we had the meltdown where the financial system blew up globally right after they said everything's fine. That's an indication, right? That's a propaganda engine to make sure that everyone keeps in line so they don't just start selling before they start selling, from what I've heard. You know, they sell first and okay, now you guys could start selling, you know. But anyway, so sometimes it's contrived that way. And there are other times where it happens, let's say coincidentally, right? So let's take this example. So if you haven't heard the news, Michael Burry, famous figure from The Big Short.
Goodbye. He's shorting himself.
Yeah. So Michael Burry came out. I'm actually backed up with some of the news. So in The Big Short, he made a lot of money by shorting the housing crisis through, I think he bought, what did he buy? Anyway, he basically bought insurance on mortgages. I forget, I'm drawing a blank on the term, but he bought insurance on the mortgages, made out big. But he was so disgusted by his investors, he's like, I'm just going to take my money and I'm just going to do my own thing. Somewhere along the line, he started his fund back up. because I didn't even know he started up. I thought he's on social media sometimes, and you just think, well, okay, maybe he's just doing stuff. But apparently his fund's been up for a while.
Just wanted to let you, he persuaded Goldman Sachs and other investment firms to sell credit default swaps against the
Yes. Thank you, Doug. Thank you. Credit default swaps. I got to go watch The Big Short again. It's been a while. Love that movie. So anyway, so what he's done is apparently he started his fund back up, Cyan Capital, and he came out with a statement so that any sort of fund of a certain size has to disclose their positions. Any large enough investor has to disclose positions. And that's a good thing. You can go look through these people. You can see what they own. Well, apparently his recent disclosure showed that he was not just short, but he bought put options, which is a leverage on a short position on both NVIDIA and Palantir. Now, we don't have all the specifics. All we see is the number of shares, and then
we call that an ouch put.
Doug's funny today. We got to get Doug a drum set, boom, boom, boom. But anyway, so he has this position he submitted, and then he writes a letter that basically says, "I'm closing the fund." What? Are you just trying to do a mic drop? Like, I'm shorting these and you're not going to see what I'm doing after this mic drop, and I'm going to close the fund and give all the investors their money back. Now, he's done this before. And so the big question is, everyone's talking about this because Burry's been talking about this for a while, and things haven't come true, even though that he's wanted them to. Like, he was even early on the housing crisis. I think he was like 2 or 3 years early in the housing crisis, like 05 or 06. He started with this. So he might be early on this, but everyone else is seeing the same thing. It's so obvious to everybody that AI is way overinflated. The question is when does it drop? Well, if Burry's right, and by the way, he bought a put 1 year out. So we're looking January of 27 put. So he's given it a full year. Now, if he's right, he makes, I think, like 20-1 results. He's going to be like, he's going to be really, really, he's going to have great returns. Let's put it that way. And, let's say you put in 1% of your portfolio and it makes you 20%. That's a good bet. Do I think he's right? I don't know. I haven't looked at the numbers. I haven't even verified that he still owns that position. But the point is when you see that, you're like, all right, what am I missing here? I'm not saying he's right. He's a very smart guy, right? Very bright and very successful. Is he correct? I don't know, right? It goes into the category of, isn't that interesting? That's the category it should go into for you. Isn't that interesting? It should also go into the, what am I missing here category. What am I missing? Now, if you own NVIDIA or Palantir, and based on this news, I'm not making any distinction of these two stocks, or whether they're good or bad. But if you own those stocks and he's shorting them, arguably he's probably smarter than you. He's smarter than probably Doug and I combined. He's a very smart guy.
Well, that's not saying much, but yeah.
Well, yeah, that's true. I got 2 dogs here I can bring in the picture. Maybe he's smarter than the 4 of us.
That'll bring us up to there.
Bring us up the level. They're Labradoodles, so they're pretty smart.
They're pretty smart.
Anyway, so the point being is, it should go into the antennas are going up category of, I should start paying attention to things. It doesn't mean you should jump out of positions and go crazy and short the market. You do whatever you want, but you should be paying attention. I'm seeing a lot of signs of you should start paying attention now. I'm seeing a lot of signs of that. And so we'll talk about a few things more here, but I'm going to give Doug a chance to talk because I've had my rant for a little bit.
No, I'm enjoying this, Kirk.
Oh, okay. Well, I can keep talking if you want, Doug. I could talk all day. I'm good at that.
What do you mean we? No, I'm just kidding. Continue.
Yeah. So I think that's something that you should definitely pay attention to. I'm hearing a ton of talk. I'm going to give you both sides here because I think it's really important to acknowledge. So there's 2 things. One is this. So the SOFR, what used to be LIBOR. So the SOFR, the secured overnight financing rate, is pretty much how the world financial institutions operate. And last weekend, I believe it was like Saturday or Sunday or something like that, it dropped 30 basis points, which is a big drop. If you look at this chart, it was right around 4.3, 4.4, and it bounced around a little bit for like pretty much the whole year. And then it spiked up to 4.5, and then it dropped down to 4.1, and then it went up a little bit, and then it dropped down to 3.9. So huge spike down. These are not normal, and these are signs of distress. Now, I'm not saying that anything bad is going to happen, but I'm saying that other people see bad stuff going on, and they're not, and they are concerned. So everyone should start thinking about, how is your portfolio positioned today? Are you comfortable that if we had a market meltdown, then you would be okay with that? Right? This is when risk is elevated, and it doesn't mean that a crash is upon us, because I still have the thesis that after Thanksgiving, the markets probably will run up to the end of the year, maybe even January, at which point I'd be very concerned about the next, rest of the year. The second year of a presidential term tends to be weak, but December tends to be strong. I'm not saying it will be, but it tends to be. So if you're looking at numbers right now, and if December ends up being flat, I may be more concerned. Either way, right now, I'm really being cautious. The credit markets are showing signs of distress, primarily in the auto market. Mm-hmm. So when you look at, I think they're called ABS. I'm not an expert in this, by the way. I'm just going, I spoke to one trader and one, I don't know what you call them, fund manager, if you will, that focus on credit. And I'm hearing different sides. So one side is that the ABS, they're blowing up. People are, they're on the subprime loan side and the auto side, that a lot of people aren't paying their bills. People aren't buying cars, and the world's going to end, basically, is what I'm hearing. Now, keep this in mind. When 2008 happened, the mortgage market is what brought down the global economy. Okay. The mortgage market is enormous. It's a huge market. Auto loans, not so big. So if we had a repeat, because what we're hearing is we're having a repeat of 2008, but with the auto market, maybe the market's dropped 10%. Like it's not going to put a dent, as opposed to, I can't live anywhere. I can't pay for my house. Well, I got my car repoed. Okay. But they're subprime people anyway. So there's a segment of the market. I'm not saying it's good, but just there's a segment of the market that's more higher risk. And from what I understand, a lot of states cap the rates, which means they can't compensate properly for the risk that they're loaning to these people. So they're buying cars, high risk people, and they can't charge them 30% because states won't allow it. So maybe it's only 15. So all of these things aren't working out. And so what's happening is the auto loan market is having a lot of stress right now. And so a lot of people are concerned, and some of these factors are based around keeping that from freezing and causing further distress in the financial system. Now, the other side of it, I talked to another guy who's he's a bond trader, and he had the other side. He said he's going hard. He said, yeah, we're definitely seeing some stuff, but it's not that bad. And he's like, I'm buying into this dip. So you have somebody on the other side. So I've talked to people on both sides. And the takeaway is, I don't invest in this stuff. So I'm not going to start now because I don't know it. And I'm just going to watch. So if you're looking at the auto companies, or not the GMs, but like the Carvana or CarMart, or I forget the other ones, AutoZone, not AutoZone. There's a few of them. If you're looking at buying those and you understand that market, then you should be paying attention. I don't know whether it makes sense to buy or sell, but if you understand it, you should pay attention right now. This is one of those times where you should definitely be paying attention. If you don't understand the market, just observe. Don't jump in and assume you're going to get a deal or short it, because I think CarMart came out with bad earnings. They were already down a lot, and then they came out with bad earnings. They dropped like another 23%. So it's possible that all the bad news is already in. I don't know. I don't touch those stocks. There's a wisdom in knowing what you don't know. sometimes you just don't play the game, like the war games, right? Sometimes the best choice is not to play. So I'm not playing in that pool because I don't know it. So that's what I'm seeing in the bond market, and it's definitely a little bit concerning. It's something that I'm watching very closely. We are seeing a I want to talk about the K-shaped economy, but is there anything you want to add here, Doug, before I jump into that topic?
No, I mean, if you want to jump on that really quickly, I can come back to a couple of things. Go ahead.
All right. Let me just discuss this K-shaped economy. And we haven't used this term, but I've seen it in a lot of places being played out. And I understand what it is, but I don't usually describe things that way. But I'm going to describe it here because a lot of people are using it. So if you don't understand it, here's what it is. So the K-shaped recovery or economy, depending on how you want to characterize it, is basically like this. So in 2008, the market crashed, right? And then what people were saying is it going to be a V-shaped recovery, a W, or an L? And if you think of it, the economy goes down, and if it goes right back up, that's a V, right? Down, up. It looks like a V on the chart. If it goes down and then up and then down and up and down and then it goes up again, that's a W, right? That happens sometimes. An L just means it goes down and stays there. Now, there are not a lot of L's in history. It just generally doesn't happen that way. What tends to happen is a V or a W or something like that, some version of that. So a K-shaped recovery is different. You might think, well, how does that work? Well, here's how it works. What we're seeing right now is a K-shaped economy where you have a dispersion between rich and poor. I can't even do this on anyway. So basically what happens is you have an economy that's moving along, right? Let's say it's moving on a straight line. And then the rich have assets and the poor don't have assets. So what's happened is that we've printed a ton of money over the last, for a long time, but especially since COVID. During COVID and then after, we printed a ton of money, okay? That printed money caused inflation. Inflation doesn't affect everybody equally, okay? During COVID, everybody got cash. There was inflation in everything, in goods and services, because people were spending it, and so the prices went through the roof. That was a different kind of inflation. We don't have that kind of inflation now. We have it some places, but not as much. What we have now is asset price inflation. So if you own assets, your assets are going up. Gold, real estate, stocks, Bitcoin, whatever. If you own businesses, if you own assets, those assets are increasing in value. You know what's not increasing in value? Your income, right? So most people are earning a similar income than they did 5 years ago, okay? But the assets are going up. The K, the upward slope of the K, right, is the asset. So the rich people own assets. They're making off like bandits. They're making a lot of money, okay? We work with assets. What we do, we manage portfolios. Gold, crypto, stocks, tech, whatever, it's all going up, right? That's asset price inflation. Now, you have people without assets. The problem with them is they're making the same income, but their expenses are going up, which means they're making less money or losing money in some cases. So they're the downward slope of the K. They're not getting a better quality of living. They have a worse quality of living. The rich people have a better quality of living because they have assets. They can sell the assets. They can do whatever. The poor don't have assets. They're living day to day. They live in a world of income and expense. Rich people live in a world of asset and liability. They're doing fine. The poor people, what's happening is the income stays the same and the expenses increase, which means you're losing money each year or you're making less. That's a tough place to be. Okay. We don't have a lot of clients that are like that because we wouldn't have anything we could do with them. But I have a lot of empathy for people like that. It is a tough place to be right now if you don't have assets. Okay. If you're a renter, if you have a 9-to-5 job, your income's not going up, but the expenses are. I mean, since COVID, everything's up at least 100%. CPI is totally wrong. So it's up at least 100%. Well, you're not making 100% more income, which means you just got poorer. That's the problem. That's the bottom end of the K. So when people talk about the K-shaped economy, that's what it is. And the problem is that if that's not corrected, you tend to get the French Revolution. You tend to get Mamdani. You tend to get, chaos, anarchy in the streets. Because if you don't have the basics of an American life, well, F the rich people, I'm going to burn their house down. That's what you get. And we're in a place, we're not there yet, but we're getting close. Whereas if things don't correct themselves, that's where we end up. We've already seen it with the CEOs. They got bodyguards, they got protection. I mean, they're worried, and they should be.
They're absolutely they're the face of evil to those that are slaving in their jobs every day.
Yeah, and it's not necessarily their fault directly, right? The fault is basically because I don't want to put it solely on the shoulders of the Fed, but the Fed causes this through their policies, and so does Congress. It's not just the Fed; so does Congress, because they don't balance the budget, they keep spending more money, and they don't care. They don't keep track of it, and it's out of control, and the Fed supports it. So they're all culprit to this. But I don't know that they can fix it. Even if you were decide to take over the Fed, Doug, I don't think you can fix it at this point. I think it's beyond fixing, but it's possible it's not, but 99.9% chance, no. So I don't know how this gets fixed other than a market crash where the poor feel better about the rich being poor as well. That's the only remedy, but that's not a good remedy either. You don't bring somebody up by bringing somebody else down. That's never a good recipe. So anyway, go ahead, Doug. I've done most of the talking here.
Kirk, and I want you to let you know you're amazing at it. So I just want to help you. If you ever need a little boost in your self-esteem, I'm here to help you with that today. You mentioned a couple things that I wanted to come back to when we talk about what's going on here with the stressing of it. So they are all. So I don't know if anybody has heard, but they're now thrown out to what we call like a balloon conversation. Just kind of get the juices flowing, whether this actually occurs or not. But they have, the administration threw out the idea of 50-year mortgages. And these, so effectively, if you do the amortization on these, it really doesn't reduce the payment that much. Like a 15 to a 30, big difference. 30 to a 50 doesn't have that does not reduce it that much. It's a very minuscule relief for what, arguably is it's a 5 for many people who aren't, don't have a plan to pay off something early. It is a 5-decade albatross. Now, there are some ways around it, and you could argue, that this could help with cash flow if people have a plan. Once again, those with the means could take advantage of this over the long run. But why are they bringing this up? They're also talking about 15-year auto loans now. All instead of figuring out a cure to solve the problem, which is of course high interest rate on high asset prices, the cure now is let's just spread out the obligated payments even further, so it feels. This is the shrinkflation of debt, right? If you think about it, what have they done with candy bars forever? And I remember the first taste that I got of shrinkflation was seeing a Milky Way bar, and this is probably 25 years ago, where they said Milky Way, the new Milky Way bar, 25% cheaper. It was also 25% smaller. It's like, okay, thank you very much for for that. Again, it takes math to get through these things. But as you can see here on the chart here, I mean, we are facing some real issues. So first of all, the median age of the home buyer in the U.S. is now 61. By the way, that jumped rapidly. Look at the spike on that. Actually, just going back 2 years, it went from 35 to almost 60 in 2 years. That's egregious. It's unsustainable. First-time home buyers hitting a record low of 21%, just as this 50-year mortgage got rolled out. Now, on top of that, some of the other pieces, I got to go back to my charts here, that they rolled is that we've also starting to see the foreclosures have surged 20% as Americans are struggling to pay mortgages. So not only are we seeing, repossessions of automobiles, but we're also starting to see more and more Americans get behind. Again, I don't know about you, Kirk, but I think there's 2 people on here that saw this a while ago, especially when they started to roll back in student loan debt, which was something that we had talked about a year or so ago. that had been allowed to be just ignored for, basically 3 to 4 years following COVID. Oh, you start to add these payments and back payments due into it, and it already, tightened budget. My utilities. I mean, I could tell you personally. I mean, I was talking to my kids about it. I remember when I used to pay $150 all in for utilities, and I actually paid for water and sewer. I'm now on well. I don't pay for water and sewer. My electricity my electricity and gas bill is now approaching an average of $600 a month, and there are some months that it's eight plus. So you think about the people, especially where I know that heating oil is big where you're at, Kirk, in the upper Northwest. Again, these are people that are literally, there's nothing they can do about it. It's not what they want, it's what they need that absolutely is absolutely something that they can't avoid. There is a paper that was posted the other day. It was by a gentleman who's the economics department of the University of Toronto. Again, I'm not here to say whether I'm right or wrong. I'm not also here to say whether it's causative or just correlated. But this this published on November 9th, Build Baby Build, How Housing Shapes Fertility. This new paper, housing costs to be a major causal driver of declining fertility. He found that higher rents led to 11% fewer U.S. births. That's 13 million kids since 1990. That's just over half the decline in total fertility rate in that period. We are actually seeing, as I've talked about a little bit in some of our last conversations, in about 2 years from now, and we know, we've talked about the One Big Beautiful Bill coming out and saying we're going to put we're going to clamp down on the amount of money that'll be available for loans for families for college. To some degree, again, we're going to start to see colleges, in theory, match what they're charging to what's going to be available. That's funny how that works. We've already seen one example. I think we showed it, where one college a couple years out, all of a sudden is going to go from like 50, 55, 60, and then back to 50, because 50 is where the cap's going to be on lending that year. This is in the graduate program. But the other thing that we're seeing with this is 2 years from now, this paper has a lot of credibility. Not necessarily, again, agreeing with the data of why or why not, but we saw a massive drop off of births starting in 2008. And so to some degree, in terms of just generational normalcy, even when you talk about the haves and have-nots and the top 1%, just over the last couple of years, the top 1% income jumped from about $450,000 to $650,000. So top 1%, which again, averages are different than median. Median is the middle part between the high and low. Median is a lot smaller than average. Average is screwed. Yeah, the bottom average is screwed by the top average. No, the average is skewed by the top average. All you need is a couple people making several $1 million to all of a sudden bring an average up and make it look like everybody's making this average wage. Not true. So the fact that we are seeing it jump from $400,000 to $650,000 of average income in the top 1%, you have to understand how big of a skew this is. It means the top 1% have absolutely increased their income by an astronomical level just over that 2-year period. So what's happened? We have seen this asset growth. We've seen this income growth at the top. The haves have had. Go back to 2008, we start to look at how we really truly recovered. And the fact of the matter is, the data, at least on family and households, is no. The continual hits are showing that they haven't had babies. So 2 years from now, we're going to have roughly 30% decline in the number of kids graduating from high school. And if those kids graduating from high school are declining, that means less kids going into colleges. That also means less kids in the workforce. Of course, there's talk about whether or not we need them in AI. There's a lot of controversy around that. But there is a massive shift going on right now in terms of the future generations. And unfortunately, instead of getting out of this cycle where in 2008 it's set back, and this shouldn't surprise anybody. If you can't afford things, the last thing you're going to feel is now's a good time to have a baby and add more cost, because I'm sure it's exacerbated. I haven't looked at it in a while, but it used to be about $150,000 to $250,000 to raise a kid. That's obviously gone up through age 18, not counting college. Clearly, you're not going to bring a child in with all the extra costs if you're worried about the budget and you're truly thinking about that. So the fact that we had this decline and now where we're at currently, and we're already starting to creep back into these extreme differentials between haves and have-nots, that's only going to put more pressure on the birthing rate, for good or bad. Not here to make an opinion, but that ultimately this renting, and this is where I don't think it is cause. I think it's or it's more correlation, because some people do choose to rent, and those people that choose to rent, who have the choice of buying, they're not necessarily going to be taken into this consideration. What he's talking about is the people that have no choice but to rent. The no choice because they haven't been able to get the homes, they haven't been able to get those assets. Therefore, they don't have a choice in playing in that world of appreciation. And ultimately, that leads to an extreme continuation of this concern at the bottom end of how are you going to continue to afford things. And this is why we're getting these creative, arguably predatory types of new structured lending out there, just to allow people to get from today to maybe push it to be able to get out another day, right? Because they can afford the cash flow for the moment. But if property taxes keep spiking like they are, insurance rates keep spiking like they are on properties, if you start looking at utilities, food, all of that, it only temporarily relieves us to the next breaking point. And this is, I think, what you're talking about, Kirk. That leads to tremendous instability. The other talk, talk again, looking at the one change. Sorry, I had to kind of look, figure out where I was looking at here. We clearly, even as the market is as high as it is, we are starting to see that not everybody's looking at this as bullish. The Fear and Greed Index, which is posted up on CNN. A year ago, we were in greed. A month ago, we were in fear. We moved into extreme fear. That was over the past week, and we've stayed there. That extreme fear, how do they bring that in? What goes into that is where they see stock price strength. That is currently dipping back, and from 52-week highs and lows, they're calling that extreme fear. Stock price breadth, extreme fear. Put and call options are now at extreme fear level. Market volatility, fear. Safe haven demands, extreme fear, and junk bond demand, extreme fear. So clearly, we are looking at an issue in which we've got some positive momentum in some areas, but the index is below the average. It means that we're starting to see the slowing momentum, these slowing areas, leading to a skittishness that is starting to spread. Last thing I want to say.
Bogus indicator. Just wanted to say that.
What'd you say?
I'm just saying, don't follow this indicator.
No. Do not follow it.
Ignore it.
Do not follow it. Absolutely. But it is one indicator of many indicators you need to be looking at. Do not look at this indicator. And just so you know, this indicator often lags the reaction, right? All of a sudden, something happens and boom, it's going to kill you the opposite of where you should be right now. So it is a sign, it is an indicator, but can show certain things, but do not follow it. Again, like most indicators, absolutely do not use that as a guidance. I did want to throw this back to you, Kirk. Yesterday, we had this week, I don't know if it was yesterday, we had a funeral.
Yep. Moment of silence, Doug.
Moment of silence here. Hold on a second. I think maybe I might have a token of appreciation for that silence. I do. I don't know if you can see it.
I can. I can see it.
Abraham Lincoln. I have one of the last remaining pennies that will ever be. So from 1793 to 2025, the U.S. Mint produced these 1-cent pieces. It has now gotten to the point in which to produce something that could only buy something for 1 cent, it cost 3 to 4 cents to make. If you can go back to the 1960s, 70s, these things before, they were pure copper. They're now worth 10 to 15 cents a piece. I'm making that number up, but let's just put it this way. It's a lot more than 1 cent. Now then they went to mostly zinc with just copper coating. Now the zinc is worth more than a penny. So who carries the change anymore? Most of the places I go to won't even let me pay cash. I get told, say, your tender isn't good here. Although, looking at it, I'm just going to pull this out. I believe that it says on there, this note is legal tender for all debts, public and private. Somewhere along the line in the last 5 years, Kirk, companies decided that it's no longer legal tender for private.
They can't. They are. That is their right.
It is their right.
You have to pay your taxes, at least at the moment, in legal tender, which is the reason for legal tender. But if you wanted to trade hogs for horses, you could do that. Like, you don't need to use dollars.
Absolutely.
But yeah, it is sad that stores are not taking it. Well, moment of silence. Okay, we're done.
I just want to say this. I'm really excited about how prices now, those things that they always price at 97 cents and more, 99 cents. The good news is they're going to go, the prices will go down, at least 4 cents to get to a nickel, because, they want to make it so affordable. They would never jump another cent on everything in order to accommodate the death and demise of Lincoln's face.
Well, we will get into next week. We'll get into some interesting stuff. There's some opportunities in the REIT space. And then we're also going to talk about returns so far this year to see what's performing, what isn't, because there's been some really eye-opening stuff that even I didn't realize. So anyway, so we're going to wrap it up. So Doug, take us home here.
Yeah. So listen. Obviously, if you're one of those people who is lucky enough to have an opportunity to have those assets, to have saved well, who have been planning to take care of things like your next of kin. Like, I'm working with someone right now who wants to make sure that their children are going to be okay. They're looking at paying for college. They're looking to do all of these, these wonderful things. Then consider yourself very, very lucky if you have the means to do that, because there's a lot of people in the United States right now that do not. That being, and it's getting harder for them to get the capital and liquidity they need. And that's going to be the main thing I want to talk about today, is that truly the area in this, the area where it creates the greatest amount of financial stress is when you do not have liquidity and access to capital. And unfortunately, we have seen over the years lots and lots of situations in which even those with lots of assets have run into many, many scenarios in which it is all crumbled like a house of cards, when they have found that the moment that something came up, whether it was house, college, being sued, losing a job, something just very much on the brink of that looseness, brought everything down. Okay. The markets, I said this the other day, they're loud right now. Signals don't match the story. We do have record margin debt. We've got the narrowest S&P breadth in history. I mentioned that in the fear and greed index. Commercial delinquencies, private delinquencies climbing past financial crisis highs. And also, one thing we didn't talk about today is that a year ago we had almost 200,000 jobs. That they just had the lowest since 2020, about 3 to 5,000, I think was reported. And we know these get adjusted all the time. But the thing is even though they're selling us on these jobs and they're always adjusting, they can only be so off. So the fact that we're only seeing 3,000 jobs tells you we've got job compression going on, and it's eating the middle and even the upper tier of white collar America. On paper, things look great. Average incomes are up, average wealth is up, but underneath it's fragility. It's not just market risk, it's blindness. We actually, there's a quote by Warren Buffett. He said, "A fool with a plan can beat a genius who doesn't have a plan." And what does that mean? It means that you need to be taking a look and understanding that the biggest risk to you is blindness, that most investors have no true map of their financial life, flying without instruments. Smart money families are going to think differently. They're going to want to see everything. I meet with families every day. So the biggest thing that you can do for me is help me to see everything I have, how it's working together, identify those risks are, so I can attack those risks now when I can afford it. That if something happens to me, my spouse is going to know where things are, and that I know that if, under most circumstances, everything's going to be okay. But the only way to find that now, income sources, liabilities, tax exposures, tuition timelines, sequencing of assets, they all have to work together, not against each other. And too many times that isn't the case. You want to make sure every dollar is a job, every risk is a boundary, every goal is a funding source. That's the difference between having investments and actually having a plan. Real worth, it isn't a pile, it's a paycheck. So if your plan or your college funding strategy or your wealth plan or your income plan is still living in kind of a set it and forget it mode. I had someone that tell me he said, I'm a couch potato when it comes to my finances, saved very well, but has no idea where anything is. This is a world of passive hope, and you are one correction away from discovering what fragility feels like. When the credit cycle cracks or tuition spikes again, those without that clear financial map are going to find out too late which side of the line you're on. So there's families that thrive, that build sufficient margins of error, and they're going to insulate themselves from market chaos, treat college and wealth like a multi-year cash flow event, not a surprise withdrawal. They're going to have clarity to prepare for tomorrow's uncertainty. So ask yourself, are you planning for today's risks? Are you assuming that yesterday's rules still apply? If you want a plan that functions under pressure, one that connects wealth, income, and your family's future, then take Warren Buffett's advice and go out and get that plan. Even if you're a fool, don't be the genius that doesn't. Go visit us at www.mergentadvisors.net. That's MERGENT, mergentadvisors.net. You can also find more about Mergent College Advisors at that same website. Thanks, Kurt.
Yeah. Thanks for coming on, Doug. That's the show for this week. Thanks again for joining us. Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shorting comment to the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.